a very long period of time, the U.S. until 2008 was making over 1 million single-family homes, often well in excess of 1 million single-family homes. Then we had a 12-year period where the industry basically reset down to 600,000 to 800,000 single-family homes, and it was right-sized. Plants were closed, a lot of consolidation, and then suddenly people realized that there's a 5 million deficit of homes built because the population keeps growing, and we have to go build a bunch of homes, and they can't find the pieces. The shortages of lumber, OSB, plywood, EWP, siding. But then you look at the industry, OSB, there's 4 guys doing it now. It's all been consolidated. A new plant is a couple $100 million and it takes 5 years to build. No one's going out there building a new OSB plant. Where will the OSB come from? Because in the end, if you're gonna build 1.5 million homes each year, it has to come from somewhere. And you can see this all throughout everything in housing due to all the consolidation that's happened. No one wants to go start a new lumber mill. No one wants to be building EWP, and you have all these shortages, and that's why suddenly companies like lumber, which have really had terrible returns on capital for decades, suddenly are having just astronomical returns on capital. And people look at it and they say, oh wow, lumber is at 900, it's gonna go back to 400 because it's been at 400 my whole career. And I take the view it's probably not going back to 400 unless they build a bunch of lumber mills, and I don't think they're building a bunch of lumber mills. And so I think you're going to see structurally higher returns on capital on the existing plants that are mostly fully depreciated. I'm not even sure if you built a new lumber mill today, you'd be all that profitable at 800 because you'd have to put new capital in, you have to put new construction costs, new steel, everything else. And so that's why there's no more supply coming. And I think you can look at this across lots and lots of industries. Fair disclosure, we own a couple of companies that distribute housing supplies and build the housing supplies. I think these sort of excess returns are sustainable, and you look at these companies that are trading at 2, 3, and 4 times cash flow and have 50% return on capital businesses. This is what value investing is about. And there's always been this mantra that when it gets to 3 times cash flow, it's the peak of the cycle, and it's about to trade at 20 times cash flow because they're going to restart plants and new supply is going to come, and you're basically buying it you want to buy it when it's losing money, and you want to sell it at 3 times cash flow. And back to what Bob was saying, where's the supply going to come from that you turn on? They've already turned on all the shuttered OSB plants. They're still printing money, and so I think people are looking at this wrong, and they're expecting the cycle to be the normal cycle where you have 2, 3 good quarters and it goes back to a decade of terrible. And I think you have a decade of good this time.
Well, what if you're a tourist in the sector and you're hearing all about how interest rates are going to kill housing demand? How do you, for people who, when they hear housing, all they've heard about is how demand is going to get crushed, home prices are already down, buying is already slowing. How do you square this bullish home builder thesis with what everybody's hearing about housing right now?
I think people have a lot of PTSD from the last cycle. People took out adjustable rate mortgages, they speculated on homes, people bought 10 homes to flip. I think you could look at housing really as a consumer durable. People buy homes because they need to live in homes. Homes appreciate because of replacement costs. It's a commodity product. You can always build more homes, there's always more land. But the components going into a home are going up, so the price is going up. I take a view that I don't really know what interest rate's going to do. And I know that there's people that need to have homes. They have kids, family formation, they're going to go into homes. I think if you look at the 1970s, home prices tripled during that decade. It was actually very good because homes appreciate with inflation. If you look at what interest rates did, interest rates went straight up the whole time. I don't think it's going to be tied to interest rates. In the end, in the 1970s, the baby boomers had kids and they needed homes. And now you have the echo generation of the baby boomers that kind of push off having kids by about 5 to 10 years. And this whole echo generation now needs homes. And I think that's what's going to drive it. People will find ways to get into a home if that means, canceling their Netflix subscription, which we just saw, or, it's moving to Texas where a home costs a third as much. People will figure out how to get into a home. And I think this work from home dynamic has really changed it, where people living in Manhattan paying, $2 million for a home, whatever it is, for an apartment can look at
That gets you 1,200 square feet, by the way.
Yeah, and they can look at what's going on in Texas and say, wow, I can get 3,000 square foot home like in a nice neighborhood. and have some money left over. I think it's going to work itself out, and I like to say in housing, I'm bullish volume and agnostic on price.
Here, I have something. So on lumber, so we put out something last year on this and got a lot of negative feedback, which was interesting because we had no predetermined view, no stake in the game, don't have any exposure to home builders or anything like that. But we saw this on sawmills where they were getting back up to full utilization and lumber prices were falling at the time. This was summer of last year. Lumber had just peaked. It was all over the headlines. And lumber prices could fall from where they were, and they did fall, but they didn't fall anywhere close to where people were predicting. And so with oil, there's this saying, they say that the inventory draws will continue until supply improves. And so I think that's kind of true across this whole set of different commodities where there's just not the ability or willingness to replace the supply capacity or to add to supply capacity, because again, there's just this pervasive negative sentiment. And I get it, right? Like the market was down today, it was down this week, it was down this month, down this year. So it's like, it's hard to kind of look past that. But you look at the 70s where the stock market was down a lot, commodities were up a lot, there was a lot of inflation. And like Kuppy was saying, home prices went up a lot, energy prices were up a lot. And so you can see kind of this combination of inflation-adjusted lack of prosperity, while at the same time you see tremendous excess earnings from all these different spaces where the disbelief allows for extended periods of over-earning. And so theoretically it shouldn't happen. And someone asked me, I went to University of Chicago, and the Chicago school is, hey, like efficient markets. And efficient markets break when the consensus expectation is that the cycle is gonna end right away. And as long as everyone believes the cycle is gonna end, they won't invest in order to expand capacity. And if there's not expanded capacity, like in housing, like in petrochem, like in oil and gas, you end up with a supply issue, and the supply issue perpetuates the cycle.